just on Super Retail Group, obviously announced a trading update and a large entitlement issue yesterday. Just as a reminder, around 90% of their earnings come from two big businesses, 50% comes from Supercheap Auto, 40% from Rebel. So 90% of your earnings from two big category killers in very good positions, and 10% then from BCF and Macpac. So basically all leisure branded businesses, anything you can store in your garage, they basically sell. So on the trading update first, look, they have broadly escaped the whole pandemic basically unscathed. April saw a big dip in sales and then they made all of that up in May. So effectively over those 2 months, like-for-like sales are down only 1.7%. So our earnings that we're basically forecasting today are not far off the earnings we initially forecast in February before this actually became a big deal. So, they've escaped this really well, partially a virtue of their strong businesses, I suppose. And during that, I must say, a huge amount of stores were actually closed in New Zealand. So they have done quite well. Online, like for most retailers, has surged. So it was around 18% of sales over those last 2 months. So up around 136%. Most important thing about that, because they're not alone there, is that the cost to serve their online customer has come down. So that was something I was actually concerned about. They seem to have managed that pretty well. The other concern from the market with this stock was the level of gearing. It was close to 1x. In my view, retailers should never carry much debt, and that was a bit of a concern. So they did come out with a 200 mil equity raising via an entitlement offer at $7.19. So look, I think the fact that now the balance sheet is bolstered, it's pretty hefty dilution of 14%, but I think this company will attract a bigger rating in the wake of the pandemic, because they've proven that they do have a relatively, they've escaped pretty unscathed, but also they fixed the balance sheet position, and that will now enable them to ramp CapEx back up, regardless of what the broader consumer conditions are doing, I suppose. So look, we've adjusted our numbers. Actually, our earnings and our NPAT have gone up quite a bit, and consensus will go up a lot as well, but EPS obviously down with the dilution. So the stock's trading on about 11.5 times FY21. We have them resuming dividend payments in that year, so it would be about a 5.5% yield in FY21, and we think they obviously now have the balance sheet to certainly do that. And the other thing just with this stock to remember, it's obviously nicely exposed to those thematics we've been talking about, a rise in domestic tourism, in-home fitness, and just general acceleration in online sales. So I think the message for shareholders, if you're there, you certainly take up your entitlement. This stock is 10% short or 15% of the free float short, so a perfect entitlement structure to get those shorts squeezed in the next couple of weeks.